All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. How are you doing, Bob?
Hello, Katie. It's a little rainy here in the Northeast United States. How is it? You're in Los Angeles, right?
Yeah, it's a little cloudy here this morning, but I think the sun will come out soon, so I'm sure it'll clear up for you as well. I know you've had some hot temperatures recently.
Yeah, it's been unbearable, frankly. It's not just that it's 90 or 95 degrees. It's the humidity level's been through the roof, and that makes it very hard to even walk down the street.
Oh, yeah, I'm sure. Well, we have a lot of great questions to get to today, so let's jump right into it. First up, Bob, we're in the third quarter now, so what is moving stocks in this quarter?
Well, up until a couple of days ago, it was tech earnings. So the big thing about technology stocks, and the reason they've been so dominant for a number of years, is that's where the earnings growth is. That's where the majority of the earnings growth is. And remember, the stocks move no matter what anybody tells you, ultimately on the expectations of a future stream of profits, or at least cash flow. And tech has been predominant for a long time. And that is continuing. But with a caveat, earnings growth is continuing in techs, but it's slowing down. The rate of growth is slowing down. Yesterday, consumer price index came out, and we had a negative print on a month over month for the consumer price index, down 0.1% month over month. They haven't seen that since the pandemic started. And the good news here is interest rates came down immediately, and there was an expectation that the Federal Reserve will be able to safely cut interest rates. And that really boosted a lot of sectors, but particularly small cap stocks, which are very sensitive to interest rates. So there's some hope that we could get some rotation. There's way too much money piling into tech stocks, frankly, and everything else, a lot of other things, is kind of unloved. Particularly small caps and value stocks have underperformed for a long time. And traditionally, these stocks, in the long periods of time, tend to outperform. This may sound astonishing to you, but traditionally, over long periods of time, small cap outperforms big cap, and value stocks, cheaper stocks, outperform growth stocks like technology over long periods. This hasn't really been true since the financial crisis, with the possible exception of 2021 and part of 2022. So people are waiting for what we call rotation to happen, move into other areas of the market, and that would be good for the market to broaden out. You don't want people to keep throwing money into tech stocks because they're not going to go up forever. They're just not. So what we need to have this happen here is this has to be more than a one-day wonder. I wrote about this in the Trader Talk this week. And you can go to tradertalk.cnbc.com and see it. So it's good to have lower interest rates. I think that the evidence is the economy is slowing, but not that much. Certainly not a recession. And so this question is, can you rotate out? So remember, this rally that we've been having for the last few years is largely based on technology earnings going up. And as I said, earnings are continuing to grow up in technology, but not as fast as it was before. So can other sectors take up the slack? And this is where I get a little concerned, because I look, it's true, mean reversion is very real. Eventually, everything comes back down to earth. But just because stuff is cheaper, like material stocks or healthcare stocks or consumer stocks, whatever, just because stuff's cheaper than something else, than technology, it's not a good reason necessarily to buy it for the last 15 years. You have to be able to show, too, that there's some earnings growth as well, on top of just being cheap, on top of it just being a value. And that's where I get a little concerned. So I don't see, for example, consumer stocks haven't seen much growth at all recently. Healthcare, these weight loss drugs, Lilly's been a monster, Novo Nordisk has been a monster, a few other stocks have been big, but by and large, healthcare stocks haven't been very big performance, not huge earnings growth either. Financial large cap banks have done okay. The regional banks, not so much, due to deposit flight. They're having to pay a lot more money for their deposits. Loan growth has not been great for these small cap, the regional banks. And they have a lot of exposure to commercial real estate. So is there a lot of earnings growth there? Maybe, maybe not. So here's the problem. It's hard to get exuberant about the market broadening out when you don't have strong earnings growth. So, and one of the things that drives earnings is just revenues go up, but that's an important factor in earnings growth. And the revenue growth outside of tech is the expectations pretty modest for the rest of the year. Maybe, I don't know, 1%, 2%, something like that. It's not dramatic. So I'm all in favor of the market broadening out. I'm all in favor of small cap stocks doing well. It's good for the market. It's healthy for the market. Value stocks doing better, cheaper stocks doing better. Great. I'm all in favor of it. It just has to be something else besides, well, it's time to rotate out of technology stocks. It's got to be a little more fundamentals behind it than just necessarily being cheaper. And that's what I still don't see. So there's my little caveat.
So, Bob, our next question is about the consumer and the state of the consumer. So, is the consumer weakening, in your opinion, Bob?
Well, this depends on what consumer you're talking about. There are very clear signs of stress on the lower end. You can see pushback on consumer stocks and consumer companies overpricing a lot. Look what McDonald's did. People started revolting going to fast food restaurants. McDonald's had to institute a value pricing meal at $5 because people were pushing back. And those people are very conscious. The difference between $5 and $8 can be very important there. So there are some signs of stress on the lower end, and they're responding to that. And I think that's a very good sign. On the other hand, on the higher end, and it's hard to define what a higher end, but I'll give you an example. I was in Atlantic City for a few days last week, and I went all over the place. It's a casino town. I went to the low, cheap food places. I went to the White House Sub Shop, one of my favorite hoagie shops. Anywhere, lots of people. I went to expensive steakhouse, lots of people. I went to lower end casinos, where you could literally bet, a few dollars, cheap slots, lots of people. I went to higher end casinos. I went to the Ocean and Hard Rock, generally considered higher end. The gaming tables, and I don't mean slots, I mean roulette tables, craps tables, they were full. You look around and say, gee, people are spending. Here's the problem. Even in places like that, it's still sort of the top 20% of households by income that are doing a lot of the spending. Now, this has always been true. The top 10%, and in particular, if you include the 20%, they do a very large percentage. More than 50% of all the spending is done by the top 20% of households because they have more money. It's not a surprise to anybody. So you can kind of fool yourself going into these places and saying, gee, everybody's spending like drunken sailors. And it may be true that the top 20% are going out for long weekends to Atlantic City and going out to nice restaurants. But look at the other end and see what's going on with McDonald's and value meals. So is the consumer in trouble? No. By and large, they still have plenty of savings left, but there's definitely some signs of stress at the lower end. So, and I would expect you to continue to hear about that.
Next up, Bob, what are your thoughts on buying Nike or Starbucks as long-term holds?
Well, I don't, and people who listen to me for years know I don't make recommendations on stocks at all. I don't tell people to buy or sell anything. I just made an observation. These are observations. The consumer stocks are under pressure. Starbucks has been a terrible performer this year, and for largely the same reasons as McDonald's. The prices are going up. And, it's a lot of money to spend $5 or $6 on, frappe pumpkin latte at Starbucks. I don't buy any of that stuff. I tend to be a plain black coffee guy myself, but it's expensive to buy that stuff. And people are pushing back. And I saw that at Starbucks. I saw that at McDonald's, even Nike. Now, Nike is a good example of it, one of the great consumer brands of all time. It's had amazing runs, but it's been terrible this year. Part of the reason it's facing renewed competition from people, and all of that's true, but everybody's facing renewed competition. You use that as an excuse every time. You're going to have a lot of companies out there that you're going to say, oh, they don't count because they're getting a lot of competition. Everybody does. Athleisure gets a lot of competition. Yoga pants business has a lot of competition. So Nike's another one. Shoes can be expensive. You want to spend $25 on a pair of sneakers or above. It's a lot. So I think that the consumer names this year, the second half of the year, the story is going to be about being very price conscious. And in my opinion, that's a good thing. I mean, I'm lucky. I make a decent living, and I push back against some of these prices sometimes. I like to eat out in restaurants. I've been doing it for years. It's one of the enjoyments of my life to go out to a restaurant. But I looked at some of these prices in the last year, and I said, I'm not going to order this. I'm not going to spend $70 on a steak. A New York strip steak in a restaurant in New York these days, $70. That's a lot of money. Oysters, I used to like oysters. The oysters used to be $1.50 or $2. Now they're $4. That's not unusual to see. I stopped ordering oysters. I mean, it wouldn't kill me to order, half a dozen oysters at $4. That's $24. But I think that's a lot of money. And so a lot of other people have thought that. So I'm not alone. And I think that you're going to see more pushback, even at the higher end, not just McDonald's. People are going to say, $4 oysters, you're kidding me. And they're going to do like I do and say, I'll pass on that. So I think that's a good thing. That's how you keep inflation down, when stuff stops selling. It's that simple. So I don't recommend anything. I have no comment on their prices at all, other than to say they're all under some pressure right now on the price front.
So, Bob, we often get a lot of questions about Bitcoin. So how are the spot Bitcoin ETFs doing?
Really well. I mean, what's going on with Bitcoin is it's doing well this year. It's up 34 or 5%, something like that. The Bitcoin ETFs launch was very successful. There was an existing trust, a Bitcoin trust that was out there already. That converted to an ETF. That's Grayscale. And so some money came out of that to buy other spot Bitcoin ETFs that Fidelity put out, or BlackRock, or Bitwise. But by and large, there's been positive inflows, and more than people expected. So I think the net inflows were something like $15 billion, which is pretty good. That's not the total assets under management. It's closer to 50, but inflows, money going in. I think that's pretty good. We're waiting for Ethereum ETFs to launch. We'll see if that happens. Ether ETFs, more accurately. That probably will happen next week. We don't know for sure, but that's the guess. That is not going to be as big. Last time I looked, Ether had less than half the value of Bitcoin, but it's still good. And I think there'll still be demand for that. On a certain level, I'm more excited about Ether than I ever been about Bitcoin. Bitcoin is a digital currency that was sort of created out of nothing. Ethereum is, how would you define it? Decentralized applications. It's about smart contracts. It's really much more exciting, and this is my opinion, than Bitcoin is, because you can do a lot with decentralized finance. You could potentially do real estate contracts. You can send money to a friend. You could even do stocks transactions. You could do stock clearing with these smart contracts. I think the concept of smart contracts embedded in the Ethereum blockchain idea is very, very exciting. More exciting to me than Bitcoin, which is just a cryptocurrency that was created using blockchain technology.
Well, we'll definitely keep an eye out for that in the next couple of weeks. Next up, Bob, we had a question about the presidential election. So how might the 2024 election impact the market?
Well, people don't like it when I say this, but the truth is the president has very little influence on the stock market. People are always shocked. They think the president controls the economy. It doesn't. The president doesn't. I mean, there are instances where the president has had an impact. When you had Roosevelt in the 1930s creating the WPA and Social Security, that those had big impacts. But by and large, our system in the United States is based on means of ownership is controlled by private people, private companies, private individuals. It's not controlled by the government. The government does not, control Caterpillar or General Electric. It doesn't. GE makes its own decisions. And that's kind of what drives the economy. Now, you can have certain things happen if you pass legislation that might affect the economy in some ways, and that does happen. But by and large, the impact, people tell me, oh, wouldn't the stock market be better under Republicans than Democrats? There's no evidence that that actually happens. Usually, markets like divided government. They like status quo generally. Occasionally, a president can have an impact. President Trump, when he cut corporate taxes a number of years ago, most people would agree that that definitely helped the stock market. And that makes perfect sense. Lower taxes, more profits for corporations, obviously. That's a rare instances, though, where a president in the consensus definitely did have an impact on the stock market. Other than that, people ask me about this election. I'm sort of, the truth is the market would be perfectly happy with gridlock again. So let's assume Trump wins and the Senate is still Democratic. Markets would be perfectly happy with that. What I don't think is not priced in, is if there would be some kind of sweep. If the Republicans won the House, the Senate, and the presidency, or the Democrats did the same thing. I don't think I think there'd be a recalibration going on at that point, because nobody's quite sure exactly what kind of policies would happen under that kind of situation. So neither of those are priced in. But other than that, people have an exaggerated idea of the influence of the president on the stock market and on the economy. And I always tell people, go back and just look at earnings. Specific legislation, if you pass about oil companies or about semiconductors, can have an impact. But generally, it's pretty specific, though.
All right, our next question, Bob. Do you think they should teach finance in middle and high schools?
Oh, yeah. Oh, boy, that's easy. I have been involved with this for years. One of the things that's very depressing to me is to watch financial illiteracy. Financial illiteracy is where people don't understand how the world works. And as a result, they don't know what to do, or they make bad decisions. So I never had a course in finance in high school. My whole generation, nobody did. I got out of high school. It was amazing. I could even balance a checkbook. I could certainly tell you for sure, I probably could not have defined what a stock was, could not have defined a bond. I certainly could not have told you what the Federal Reserve was when I got out of high school in, when was it, 74, 50 years ago. I certainly could not have told you who the Federal Reserve was and what they did. As a result, and I couldn't have told you exactly what happens in a mortgage. I had to find out. And you stumble into this in adulthood. Imagine if you had a class in high school where you actually had to learn all this. What's a stock? What's a bond? What's a Federal Reserve do? And what do you do when you take out a mortgage? What happens? We'd be better at it. And I think that financial illiteracy is a major problem. And it leads to stupid investment decisions. People don't know what they're doing. Or worse, they can be influenced by idiots who are trying to take advantage of them. Mountebanks, charlatans, frauds who are trying to take their money from them. And I think that this should be an urgent priority. And people ask me if I'm worried about the stock market, or am I worried about the S&P 500? I am not worried about the S&P 500. I am worried about people understanding what the S&P 500 is, or understanding what the economy is, or what the Federal Reserve does, or why the economy goes up and down. Or they think some magic person is going to come out of the sky and suddenly they're going to make tons of money and not have to work anymore. It's not going to happen, no matter who's elected. It's not. So that's what I want, more education.
All right, Bob, and our last question for today comes from someone who's 23 years old, and they asked, if I were to invest $2,000 in my Roth, where should I go now? What do you think?
Oh, that's easy. Look, I don't give investment advice. I'll tell you what I did. I wrote a book, called, it's basically a summary of what my whole career is. It's called Shut Up and Keep Talking. It's on Amazon. You can get it now. But there's a chapter in there about what I own, my entire investment history. Most people talk about the stock market, don't ever say that what they actually own. I'm one of the few people that's ever come out and said, here is what I own. And not surprisingly, most of what I own is index funds. I own single biggest holding I have is the S&P 500 index fund. I've owned it for years. I also own a mid cap index fund. I own a small cap value fund. I own an international fund. I own a bond fund, and I own a money market fund. That's about as basic as you can get. And believe me, you'd be fine with that. You think you're a genius? You want to go out and pick stocks? Good luck. I think you're going to find out that if you know how to accurately look at your investments, you will not outperform the market. You might think it's fun, and if you do, that's great. But if you think you're going to be a genius and outperform, you're probably wrong. In fact, the odds are overwhelming that you're probably wrong. So if I had to invest $2,000, I'll tell you what I did. I went out and I bought an index fund. And I'm going back to the 1990s now. When I first started investing, like I started CNBC in 1990, I had no 401k. No, I was 35 years old, I had nothing. And I went out and bought a very broad mutual fund. The only individual stock I ever owned was General Electric, because GE owned us. And that relationship was disastrous. I wrote it, it's in the book. Those of you who know, General Electric was the biggest stock in the world in 1999 at one point. And I worshiped Jack Welch. He was the CEO. He was my big boss. I knew him. He was a wonderful man, but I had a misplaced confidence in his ability to beat the world. And that cost me very dearly, that misplaced overconfidence in him. And so you learn. And those of you who want to know my path to learning by hard mistakes, costly, painful mistakes, it's in the book. I detail exactly what I did with General Electric stock, because it was the only stock I could own. And I met Jack Bogle, the founder of Vanguard, in 1997. It changed my life. He convinced me that don't try to beat the market, go with it, owning index funds. And essentially, that is what I have done since then. So again, you're interested, it's in the book. Feel free to take a look at it. If I was 23, and I have told this to my nieces and nephews who are in their 20s, the one simple thing that you can do at 23 years old is buy an S&P index fund and don't worry about everything else right now. That would be the simple. That's what I tell my family. So you do whatever you want. If you think you can beat the market, go ahead and buy an individual stocks and trade them. I think you're going to find you won't.
Yeah, I think that's really helpful, especially for newer investors to hear, Bob, because sometimes we talk about this, investing can be boring and you're just kind of holding on to it.
Right. That's the problem. It is, to a certain extent, it is boring. I've had people actually say this to me. That's it. I've shown them my portfolio. You can put it on an index card because they are expected, okay, so you're the stocks correspondent for all these years at CNBC. Show me your portfolio. And I show them and they said, this is it. This is what you own, the S&P 500. That's it. There's not some secret sauce. There's not some, leveraged inverse Malaysian bonds that you own that no one on earth owns and only you know about. No, there isn't. It's all a lot of nonsense. You build wealth slowly. So here's the problem. Bogle knew this about the boredom part. And he always advised, he told me this at the very beginning. He said, your viewers are not going to like hearing about investing in the S&P 500. So what you tell them is let them take 10% of the money and go gamble with it. So you got, $10,000 in the stock market, take 1,000 and go buy stocks on your own, but keep the other 9,000 in index funds. Now, he said, if you know how to accurately judge your portfolio returns, and he emphasized accurately, then you're going to find out, he said, nobody's going to outperform over long periods of time. Nobody's going to do that. His point was a lot of people don't accurately know how to judge their real returns. People lie to themselves all the time about what the real returns are versus index returns. And that's a problem for a lot of people. People tend to be overconfident in their own abilities. Katie, there's a very famous survey that was done about people asking people about driving. And like 80% of people said they were above average as drivers. Well, of course, that's ridiculous. 80% cannot be above average. By definition, you can't. So there's one classic example that people display overconfidence in, but it happens all the time. People are overconfident in their ability to pick stocks. They think they tell people, they tell surveys. So people tell everybody they can outperform the market, and they can't. They don't. They just deceive themselves and the rest of the world. And when you see that, again, you got to get a little seasoned. 34 years of sitting here watching these stocks and watching these returns and watching these surveys, you get to understand what human nature is like. And that's when I stopped doing that. Oh, I'm smarter. I think I know something nobody else knows. And when I finally sat down, Bob would say to me, what do you think you know, Mr. Pisani, that you can pick stocks that nobody else on earth can? And when I finally thought about it, I said, I know just about what the rest of the world knows. I might have hunches, but that's not necessarily an investable idea. So anyhow, you know what you do when you get older like this? You get a lot more humble. And a lot of this is in the book too.
Yeah, I would definitely recommend all of our viewers check out Bob's book, Shut Up and Keep Talking. That's all of our questions for today. So thank you all for sending in your questions. Thanks to Bob for all of your answers as always. And we'll see you again.
Thank you guys.
Thanks.